1:45 p.m. 9/30 2011. What is this all about again? It's the SMF Index Market Awareness Report. And for those who have watched previous videos of the public watching how we work with our MMT apprenticeships on a daily compounded level, that you were told that at times we tell innocent people that may be viewing the videos or whatever, you can always check with your consultant, but what we always do is we give our opinion as to what things are going to be. And the opinion was that 2011 was not going to be what everyone said. Geithner was wrong. He admitted that the growth was wrong. So did Mr. Bernanke, who said that growth would remain at year end by 3.5%. And lots of various different types of firms out there had the same forecast, and so did economists worldwide and U.S. professors, whatever they were. And it has not worked out that way. And that the bear market tape here, this is a weekly S&P 500 index, and we had a great run from the 2009 lows, no doubt about it. What a great time it was. Then we started putting in those calendar year tops, as we said, but then we said they were not going to be sustainable, and we were going to go to much lower levels, because we could see that the growth contraction and the writing was on the wall, without doubt. The analysis of the live videos and before these events were ever going to occur on this weekly chart is we are finally right back down here to the calendar lows, and I can only tell you that we're going into, we just finished, it's the end of the quarter, today was, and on this weekly level right here, when we started, we're going to update our weekly formula, because when we started shorting the S&P up here in that first weekly, and then we really got aggressively short down to this bottom here, that was that wonderful 3-week haircut that people took. And we're about to approach the 100-week moving average, which just so happens to be on the S&P. It was 1190. 0.56 on the S&P. In this last weekly run, one of the things that you will know, yes, so basically what I want people to understand is that the 100-week moving average here at 1190, when we had that weekly rally and we went up there in our SMF platform, we got up to the 1195 area, and we just hit that golden area right between 1200. That's what we said in previous updates in MMTs. You were here as we were doing that analysis, and we shot straight back, and we're below the 200 week, and the 200 week is declining. The 10 week is drifting downward. And since we started selling short up here, we had a mathematical equation that would guide us as a mathematical data set of points as to how these weaknesses would occur. I'm going to go over here to the daily chart of the S&P 500, where you can review the length of rallies, the length of rallies, the length of rallies, but the reversals we did, every one of these trades in here. And as a matter of fact, right now on the S&P, we cashed in these contracts on the high of the day. And these had gotten wholesale at a very low level when we were up here. When we were up here testing the daily highs, and we were shooting right up here when we had that rally, and there was the failure, but here was that daily up move that one time, and we were lower here, and we kept reversing. These were on sale at the time, and here's your 100 week and your 10 week selling right into it. Now you're below that. But let's take a look at some of the contracts that got in here. They bought 13,000. But all of these orders that just were printed were purchased, 38,000 again on the 1150 put. That is huge. On the end of the quarter day, moving forward, going into October now. September is out of the way, and we're dangerously closing down toward the lows. And that's a $177 million purchase here. That's how big the dollar cost risk increased for insurance today. Now, moving forward, we are going to monitor the calendar year lows, because if we break the calendar year lows, then we go much lower. And the thing about it is, so far, at every single area, we have held these lows and these weekly lows. And we have not yet. Every time that we don't break them, then we have to go long. And that's why we got the 5-day rallies or the 4-day rallies or even the 3-day rallies. But we also got the reversals too. Okay? On a daily compounded level. And understanding where the net waiter and buyer and the seller and the earnings and the worldwide events and everything that's combined and the exchange model was, how was that all going to play out for the bulls? It played out miserable for them. Like we've always said on the history of the Dow and the S&P, stimuluses. Listen, the economic indicators that we have show that even if you do get a resolution out of the banking crises that are in other parts of the world, you're still are going to be in a recession. It's unavoidable. Why? Because you're already in one. That's why. People can never know when they're really in one, but you are. And the thing about it is, when these calendar yearly lows break, we're going to take a look at how that S&P can get down to my 1062 handle. Of course, it's going to have pit stops before there, MMTs, but it's a special update that we closing down toward the low of the daily body. And yes, we're going to get to a point that if we do break the low, we have the quarterly earnings in October, we'll hit a low where they're tradable back up just like this, or just like this, and then shortable again just like this. Now, when we break it down and we can capitulate down there in that bottom, they're going to take all the premium out of the call side again, and the put side's going to get way up there in value. And if we break the calendar year low starting Monday, and we'll do a lot of training about this on the S&P. We have quite a series of S&P index options and analysis before the events actually occur. And what we're going to do tomorrow is we're going to update our S&P 500 spreadsheet from the full 5 days from where the top reversal down to today's closing bottom. Today we're closing on the S&P 1131.42. I mean, we did not break below my 1130 handle. Okay? And that the 100-day simple moving average, just remember, that's way up here. That's 1253. But when we start looking at the 1172 as the 40-day simple moving average, now that 10-day, all eyes are going to be on that 1162 reading on the 10-day simple moving average. These are all public indicators, though. We use our SMF market maker platform because it gives us the precise mathematical equations. This is what the public is going to make decisions on. The percent DS is 33.59. The MACD is minus 14.4. When this thing hits a certain negative ratio, we'll finally put a bottom in. Right now, we are very, very tuned to breaking these lows. Okay? As far as what happens over the weekend, if we gap below it, we will capitulate down. And any other good till cancel stop market orders that are in here at support will be triggered on that opening bell. And down we will go. And if we break the 1101, so if we gap below it, we have to gap below certain levels to start another round of selling to break the calendar year 2011 lows. That would occur with the gap down scenario Monday, and vice versa. If we're going to hold support, we would gap up and pull back, and we would start to continue to grind out the calendar year low for possibly another upside. There's scenario A and B. So we'll be prepared for both. Right now, the calendar year has closed miserably low for the bull, and the bear, as we're talking about these reversals, we did that one. Go look on stockmarketfunding.com. There'll be an index when it was time to get long in a 10-day rally and how they would all fail, and why this 2011 top was the way that it was. And we did tell you step by step in the calendar year on all of these events. All of the live videos are there. They're truthful. But once again, the analysis was on the other side of all of your economists that were talking about big growth. Well, it wasn't there. No, it was never going to be there, because the stimuluses ran out and the steroids stopped working. And everybody had 4% growth. Oh boy, maybe we're going to get 2.7, and they kept dropping it. 3.5. All the firms had it. Go do your homework. But take a look at where we're at today, and take a look at the SMF analysis over time, when we said the big correction was going to come here. And not only that, upside volatility to sell. Every rally has been sold ever since. Every rally up here was sold. Every counter rally was sold as we said it would be, and now we're down here, and if we break below it and we start factoring in all the earnings, well, the S&P really, if the earnings on the S&P are around, I don't know, don't quote me on it 100%, I don't have my calculator in front of me, but let's say around 1173 to 1175, that'd probably put the S&P somewhere around 970. Couple hundred points from here. In the near term, we have support levels when we break it. We'll be ready for the trade management. This is the calendar year, quarterly end today, and they all ended in the red. S&P 500, once again, the risk on protection, 13,000 contracts. Do the math. These people were buying big for protection because of this low. It's that extreme. And if it breaks it, well, these are institutional people in the volume that have this kind of money. And that is a lot of money. And the thing about it is, it's 1150 put. And if the S&P closes above 1150 in the monthly expiration in October 22, then all this 177 million goes bye-bye. And someone else collects it. So we'll see what happens. If we break below it, they're going to get paid a lot of money. However, if we don't break below it and we start for whatever reason that we have another rally up, we take it. Or if we have a break below this and we break in here, we're going to take that even further down to break these trend lines. S&P 500, bear market, S&P 500, S&P bear market trades, long and short, S&P bear market, weekly, daily analysis. See, it's a weekly chart. Here it is. And here's your major trend line. The thing about it is, these are the 2010 lows down here. And we start getting down here into my other targets of around 1062, 1052. You break these support levels. Well, you do have some pit stops. Here's one. But we'll use our platform because there are others now. And 1055, a 1078, you know, look at, you come down, you test supports, you bounce, or you sell through them. This is the key weekly support, a gap below it, the kiss goodbye. In the short term, we're even getting within the math right here is that the percent DS is at 21.17 on a weekly. If we do capitulate down in here, we're going to be looking for an immediate reversal to the upside. And that at some point when we get oversold enough on a weekly is when the better opportunities will be there for the bull. Right now they're very bear weighted and very bear orientated. And short sellers make money and bulls make money. They both have an agenda. We're neutral to the market. Once again, the risks are high at the 1150 put, and the S&P 500 closed down toward the lows in this miserable quarter, 9/30/2011, and MMT apprenticeships have been going through every process and holding their road.